Good morning. Today is Wednesday, November 18th, and thank you for joining us for another edition of Market Commentators podcast. My name is Andrew Wilms, and I am the CEO and President of the Milwaukee Company. Joining me this morning is Mike Wilms, who is our Chief Operating and Compliance Officer, but Jake is unable to make it this morning. So, Mike, how are you doing?
I am just great, thanks.
Good. Glad to hear it. A
I,
quick
you know, I
reminder.
guess maybe not as great. I mean, there's ice on the bay up here.
Oh, wow. Yeah, it's getting cold fast here in Wisconsin, that's for sure. Quick reminder to our listeners that nothing in this podcast should be construed as investment advice and that the views expressed by Mike and I are our personal views and not those of the Milwaukee Company. And with that said, I'll get started, Mike, if that's okay with you, giving a quick recap on what happened in the market since our last podcast.
That'd be great.
Last week, we saw the continuation of a broad market trend seen for several days now, with the value stocks going up and growth names underperforming. For the week, the Dow was up about 4%, the S&P rose just over 2.5%, and the Russell Small Cap Index grew by 6%, which is a somewhat new trend or new development, I would say, while the tech-heavy NASDAQ declined, or I'm sorry, grew by just 0.5%, excuse me. The market moved sharper higher on Monday on news of Moderna's COVID-19 drug, and which I'll talk about in a minute. And the Dow Jones Industrial Average was up 400 points. The S&P gained 1.2%, and the Nasdaq rose just under 1%. Yesterday, there was news that Amazon, Mike, you might have heard this, but that Amazon was entering the prescriptions online business. And that, coupled with disappointing U.S. retail sales, drove the stock market rally, cooled it off a little bit. The Dow slid by more than 150 points because some of the companies affected are prominent members of the Dow, while the S&P dropped about 0.5%. And meanwhile, all of this is happening, as we'll talk about in a minute. COVID cases, hospitalizations to death are continue to increase, which about whether this market rally can continue. We'll talk about that later on here in the podcast. So with that market update, Mike, how about bringing us up to speed on recent economic developments?
Well, I think one of the key points is Federal Reserve Chairman Jerome Powell has made it pretty clear the Fed's looking at the impact of the pandemic as being a risk to the economy. He's advocating for the folks in Washington on both sides of the aisle to kind of get together and come up with a new stimulus package in lieu of the existing unemployment assistance running off here on December 31st. Yesterday, they announced retail sales rose at 0.3% in October. That's 6 straight months in a row that retail sales have increased, but it is a slight slowdown from the 0.5% increase in September. One of the things that has been closely watched here is an indication on how the economy is doing has been unemployment claims, and unemployment claims did drop by 48,000 to 709,000 for the week ended last Thursday. And the forecast is for just a slight drop to 707,000 new unemployment claims when the numbers come out tomorrow. So that part of the economy, unemployment claims and continuing claims are continuing to trend lower. The one interesting piece of news that came out this morning is on housing claims. Housing starts came in at 1.53 million for the month of October, which is up from 1.41 million in September and up from a trough of 938 in April.
Great. Well, that sounds very encouraging. Well, that having been said, let's take a quick look at what's going on in the COVID world. We're all hear about that. Most of it, far more than we probably wish, but there are some good news, and I want to share a little bit of information about that. We first, I think just about everybody has heard that Moderna has a new vaccine that proved to be almost 95% effective in a 30,000 patient study, which is extremely positive. And Moderna's drug, by the way, it does not have some of the problems that Pfizer's vaccine has. It doesn't have to be stored at super cold temperatures like the
Exactly.
Pfizer drug. And Moderna says they can have 1 billion or more doses ready by the end of next year and many thousands of doses done before the end of this year. So that it looks as though we have the medications we need to bring the COVID-19 pandemic to its knees before the end of next year. Um, and so, from the market standpoint, that's obviously been a very positive development and has been reflected in the way stocks have rallied. Speaking of Pfizer, they're preparing to seek emergency use for its vaccine from U.S. regulators, and which would make it available very quickly. But until the vaccine becomes widely available, there seems little alternative to more restrictions in Europe and US, where caseloads and hospitalizations remain high. In the US, there were 148, 532 new cases and 581 deaths reported yesterday alone. And there are now a record high 73,147 COVID patients in the hospital, which is a major concern because it creates the risk that our health system really could be overrun, which would be not only terrible on a human scale, but would also be very bad news for the markets. So, with all that being said, Mike, I'd like to ask you, with the rally in equity markets around the announcement of the vaccine trial results, what are your current thoughts about valuation and risk?
Well, the first observation, in going back to your market recap, with the rally on Monday, both the S&P 500 and the Dow closed at record highs. And you really need to start questioning valuation and what can we expect from the market moving forward through the end of the year and into 2021. A couple of the large Wall Street firms have put out some pretty fancy forecasts, over 4,000 on the S&P 500, and we really need to think about whether or not that makes sense. So if you look at the current earnings estimates for the S&P as a whole, for 2021, the estimate is approximately $165. That would be up from the estimate of 131 and change for 2020. And it's an estimate based on the fact that we still need to get through the fourth quarter. That's in comparison to the $162.93, which was the actual S&P earnings for 2019 or 2018, excuse me, 2019. So if you look at where the S&P closed on 12/31 of 2018, it was at 2505. So right now we're slightly over 3,600, and you need to kind of look back and make your own estimation on what's driving the change in valuation on essentially the same earnings. And my takeaway would be that 90% of the market impact has been the Federal Reserve. And from two perspectives, they reduced interest rates by 150 basis points. As a example, Verizon did a $12 billion bond deal last week. It was a number of different maturities from 2 to 40 years. The 2-year piece was priced at just 0.4% over a comparable treasury, and the 40-year piece at 130 or 1.3% over a 40-year treasury. And that just seems kind of not a whole lot of yield for a triple B, barely investment grade corporate bond. So, and a lot of that is being driven by the fact that the Federal Reserve is continuing to buy large amounts of fixed income securities. They're buying $80 billion of treasuries every month and something in excess of 40 billion in mortgage-backed securities. And they do, for the first time, have a program to buy up to $250 billion worth of corporates. And that's kind of a new development. It took them a while, actually 85 days after the CARES Act was passed, to develop a program to purchase corporate bonds, and basically in the format of a tracking a diversified fixed income corporate bond index. So you're pretty much looking at a fixed income market without much, if any, yield. And the equity markets are kind of the TINA effect, or there is no alternative. So um, yeah, that's kind of my take on this. Andy, any thoughts?
Well, I think you're absolutely right that valuations have gotten, extremely high given the relative to the current situation in the economy and in the country with regard to this COVID-19 pandemic, um, and its impact it's been having. I would also agree that a lot of this is in fact being driven by the Fed because there's really little justification for it. I mean, if we never had the COVID-19 pandemic in the first instance, then the Fed never had injected all of this capital or liquidity into the economy, then I think if you went back, I did not do this, but I wonder if went back and looked at what the projections were for some of these major firms prior to the COVID-19 for the market where today, I think the market's already surpassed their pre-COVID-19 predictions in many instances.
I
So,
think that's a correct observation.
so the point being that it's hard to justify the valuations being this high, other than the fact the Fed has injected all this money into the economy, and that a lot of this money is ending up in the stock market, or perhaps we should say in investors' pockets, which is not what was intended in the first place. So I don't know how the Fed is going to continue justifying in its mind this incredibly loose policy that it's predicted. I know it says that it's necessary to keep the economy afloat, but it seems to be doing much more for the stock market than would be intended. And so sooner or later, I think there's going to be a day of reckoning, and that's where the risk comes into play in my mind with the stock market right now. Now, I realize that's a minority view and that most forecasters are predicting the stock market to have another great year next year. But to me, when prices go up, risk goes up, and investors need to keep that in mind. And it brings a whole other issue, Mike, which is we're seeing this rotation now from the trendy momentum stocks to the cheaper value stocks. The switch in that direction that occurred last week was the most violent on record, eclipsing even the turmoil saw in 2008 financial crisis or the bursting of the dot-com bubble. And so this again goes to my mind right back to what you're talking about with the Fed. This money is coming into the stock market, and it's pushed tech stocks so high that it's going into value stocks, which have been beat up for years because there's nowhere else to go with it. Bonds are not a good place to go for many people because they pay virtually no interest, and they have tremendous interest rate risk right now because, as we all know, bond prices fall as interest rates go up, and it's not really, as you pointed out, feasible for interest rates to go much lower. So that's why I think, we've seen value stocks, this rotation into value stocks, even though value stocks have underperformed dramatically for the last decade or so. I mean, if we just look at the last 5 years, the value components of the S&P 500 have risen 50%, whereas the growth components are up over 131%. So, so that's kind of what I'm seeing as one of the consequences of all of this. That raises the question as to whether or not this will have legs, this value rotation. And I think it depends on your perspective. I mean, the development of the vaccines, really could bring an end to the economic crisis. I think the economic recession, and I think that will in fact occur. And value stocks have a long history of outperforming during economic recoveries because of their stronger earnings and balance sheets. And in addition, from a longer term perspective, I think mean reversion, that values underperformance over the last decade or more should provide tailwind for that sector going forward, because, as we've talked about, growth stocks have become increasingly expensive. For example, JP Morgan found in a study it performed that value stocks had never been this cheap compared to momentum stocks on a forward-looking price to earnings ratios. So even though I think I agree with you that the market rise has been driven by a lot of that's attributable to the Fed's actions, and that the Fed's actions have also encouraged the rotation into value stocks, I don't see that rotation necessarily ending anytime soon. And my view is that long-suffering value investors will have a better outlook than they've had for a very long time.
The old every dog has his day in the sun.
That's a very good way to put it. Do you share my view, or what's your thinking?
The part of the majority of the value component of the market is around financials and energy stocks. From the financial perspective, a rise in interest rates helps them with net interest margin. And to this point, the loan loss reserves that have been booked haven't experienced actual write-downs with loan defaults on the bank's portfolios. So far from a financial standpoint, the value looks like a decent place to be with continuing upside. And the big question mark is energy and demand relative to supply. So much of the OPEC supply has come off the market here, and it's gotten to be a challenge for the energy companies here in the U.S. to actually make money at $40 a barrel. So there's still a lot of question marks out there, but there is a market rotation into value, and most of the Wall Street firms are predicting that will continue into 2021.
And most of the Wall Street firms are not predicting a big market correction anytime soon. They feel that the stock market rally will continue. And I'm certainly not predicting that the bear market lies right around the corner either. I'm not in the prediction business. That's not our approach to managing portfolios. But I do, and I've said this repeatedly, but I'm going to say it again, that whether you should be overweighting or underweighting equities really at this present time depends in large measure on what your investment objective is, and your tolerance for risk is. And those things aren't necessarily the same. You can have a person who's looking to grow wealth but wants to do so more conservatively, or people who are looking to preserve wealth but want to do that a bit more aggressively. But if your focus is on creating wealth, then I wouldn't be too worried about the high valuations, because they won't be long. Eventually this will rectify itself, and over the very long term, equities tend to move higher. So I don't think, if you have a long-term investment horizon, you can tolerate some volatility, don't worry too much about it. But
that's exactly right. The long term, the equity market has been the place to be for the highest returns. And, just going back to your comment about, yeah, we're not in the prediction business, but the folks that are calling for a 4%, the consensus is for a 4% GDP growth for 2021, which is why some of the Wall Street firms have got some pretty fancy market forecasts for 2021.
Well, yeah, but yeah, and it's all relative, right? We're
Exactly.
4% off of where we are today, versus so that's but and just to finish that train of thought, on the same token, if you are worried about wealth preservation more than wealth creation, and you don't want to deal with a lot of volatility and fluctuation, and you're just do not want to endure big market swings, and you want to keep some risk off the table, then I think lowering allocations to equities, or perhaps implementing some hedges against your equity position, which you and I do a good deal of. I think that makes sense. No, even knowing that the likelihood is that you may suffer lower returns for a time, but your
For some period
drawdowns,
of time.
if things go worse or go badly, won't be nearly as great.
Exactly.
So I think that pretty much wraps it up for me today. Mike, is there anything else you wanted to cover?
Nope. I think we've hit all the high points for today.
All right, well then I'll bring our podcast to a close. I will tell our listeners to please keep in mind that you should not act on anything you hear in this podcast until you've discussed it with a qualified financial professional who is familiar with your personal situation and your investment objectives. Mike, thank you very much for joining us. Jake, I'm sure will be joining us again next week. And in the interim, have a great day.
Well, have a great day, everyone. Thank you.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.